Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today is Kelly Halverson. Kelly, welcome.
Hey, Jim, thanks for having me.
You're welcome. Kelly is he told me his title, the head actuary, he's not executive vice president. Tell me your title one more time, Kelly.
Vice President and Actuary, Individual Product Development.
Okay, which means he's very high up. There's an old kind of, when I've been in the business for a long time, Kelly, as you know, and there was in these small towns in Iowa, there was what they would say is that when you came into the town, you would see the presidents of the company's big house on the right, and right next to it was the head actuary's same size house, because if your kids are numbers driven, actuaries are one of the highest paid and employees at the company, and they really run the numbers to make sure the company's profitable and everything. So most of them do not have as great a personality as Kelly does. I would tell you, I've met a lot of them, and Kelly is by far and away got the best personality.
I appreciate hearing that. Thanks, Jim.
You're welcome. All right. So here's my layman's example or description of an actuary is like the insurance company's engineers. They're designing the product. They're designing to make sure the product's not going to fail. That it's going to work out. So today we've got a lot of, this is going to be one, if you have insurance policies or you're thinking about buying insurance policies and you're going to do infinite banking, or you're just protecting your family, or you've heard this or you've heard that, this is the guy that you want to talk to kind of straighten out all of the, what's real and what's not. So, Kelly, first of all, let's just talk about, what does an actuary do? And how did you get interested in being an actuary and, growing up? You're from Nebraska?
No, originally from South Dakota, but you already started the intro with a good tie into my career path. So when I was in high school, I was dead set I was going to go to either University of Iowa or Iowa State and be an engineer. And my spring of my senior year, my older brother had told me about actuarial science, and he said, "Yeah, if you're good at math, you like accounting, yeah, this would be great fit for you." And I said, "Well, are you doing that?" And he was a math major at the time in college, and he's like, "Oh, I tried that at first exam a couple times, I couldn't pass it." That was what sold me. It's like, "Oh, I've got to be able to beat my brother at this." So, nice. So I started out as a double major, accounting and actuarial science at the University of Nebraska, and then a couple of years dropped the accounting major and focused on the actuarial side of things and never looked back. So it's going on 20 years now since graduating college nearly. So
remind me where you grew up in South Dakota. I can't believe I forgot that, because I knew that.
Yeah, in Millbank, South Dakota is where home of the Bulldogs.
I've been to Millbank. I've been through Millbank. It's not big, right? So, I always say, I love South Dakota, by the way. I love the state. I love what Kristi Noem's doing. We don't get political on this show, but I do love what she's doing, and I love the way she's running the state and not shutting things down. But I'll tell you what, South Dakota that's how you run a state, and that's how you bring business to the state and everything else. And there's always a toughness to people that are from South Dakota, Kelly, because if you can make it through the winter up there. Now, I'm just telling you, I'm in Florida. I still own my house in South Dakota, but I'm in Florida most of the time. And but the winters up there, they will, adversity introduces the man to himself, and the winters up there are definitely adverse.
Yeah, that's the best part about moving south, in quotations, coming to Lincoln, Nebraska, about 6 hours south of Millbank.
Yeah,
I couldn't believe how much warmer the winter was even this far.
Yeah, the winters down there aren't that bad, right?
Yeah, yep, exactly.
Kind of more like Kansas City than South Dakota. But yep. All right, so what does an actuary do?
Yeah, so it depends on what part of the industry you end up choosing. For me, working in life and annuity products, it's a lot of we do a lot of benchmarking, look at a lot of our competitor products, and really go through the detailed product filings to better understand our competitor products, understand what our options are in terms of design. So, we do end up using a lot of the theoretical stuff we learned in college, and we don't necessarily apply take the theory and use that really in a raw sense. It's applying that to spreadsheets or different pricing software, that kind of thing, where you take those learnings and you make it more of an applied basis. So we're doing experience studies, look at the lapse behavior of our existing business, how have policies performed over the last 10 or 20 years. Look back at when we started doing fluid-based underwriting, we took some guesses as to what mortality is going to look like. As time progresses, 10, 20 years on, we get to understand and review that experience and better know, is it, are we getting preferred plus like mortality into our preferred plus book? So we do a lot of that actual to expected analysis on lapses, expenses, mortality. And then that all flows in through the dividend declarations as well. So a lot of it is looking in the rearview mirror to try to decide where we're going to go next.
That's awesome. And one of the things that I always say, like when I'm explaining insurance to somebody, I always talk about term insurance, right? And I say, Kelly, if you and I were going to start an insurance company, we'd just sell term insurance because there's not a lot of term policies that pay a death benefit, and that's the only benefit is the death benefit, right? And that the company doesn't think you're going to die. Like if you buy a policy at 35 years old or something, the company has actuarial data that says the chances are really low that you're going to die, but you got to protect your family. So you buy it, right? And then when you're 65, if you wanted to buy a 30-year term policy, the insurance company would laugh at you because they know within that 30 years, your chances of dying are closer to 100% than the 1% or less. So, what I always say is when you buy a term policy, you're betting against the insurance company, and they have actuarial data on their side. And I've heard that, if I told you, okay, I'm 55 years old, I grew up and this is where I grew up. There was 1,000 kids in my high school. You could tell me how many of them are dead by now, right? And with some other data, you could get really close to telling me how many of those people are dead, right?
Yeah. I mean, you have a pretty good guess. If you've got a big enough number, that's the key thing you threw out there, the 1,000 lives. So law of large numbers. Once you start getting a big enough population, and you understand what part of the world they're from, you understand the mortality of that overall group of individuals, you can get a pretty good handle on that for sure.
All right. I think by the time we get this done, Kelly, we're going to take this recording over to underwriting. You're going to upgrade me from select to preferred plus. They say I'm a little bit short for my weight, but I'm just telling you, I if I could just get 6'3", 6'4" on that application, I might sneak in just right under the number for preferred plus. But all right. So let's talk about, one of the questions I get a lot when we look at like a whole life policy. We deal mostly with whole life policies, and I want to touch on kind of how how a whole life policy is kind of manufactured. But people will say to me, well, how does the insurance company guarantee 4% gross? Because they're not getting 4% on their portfolio now, and how do they do that? Can you just touch on that for a minute?
Yeah, and this is a really timely question too, because it fits in really well with the regulation change that we at Ameritas and the entire life insurance industry is dealing with. As end of last year, the 7702 changes just got passed, so there'll be a tie-in there as we move into that part of the discussion. But the 4% guaranteed rate, which it's commonly called that when you look at our whole life policies. If you look at a specimen contract from Ameritas, it's going to say contract rate 4%. And what that means, it's not going to say you look at your guaranteed cash value at year 10 and it's $10,000, and you look at your guaranteed cash value at year 11, it's not automatically going to be 4% higher. That 4% is used in the guaranteed cash value determination, but it's really more of a reserve calculation. So to your point, the gross mortality and the gross interest rate used in determining guaranteed cash values is 4%. So it basically says when you look at the maximum age, let's say age 121 on $1 million policy on a whole life contract, doesn't matter which company you're looking at, they're all going to have the exact same guaranteed cash value at age 121. It's going to be exactly the same as the death benefit. And that's the way those guaranteed cash value calculations work, is from the time you issue that policy to the time they hit age 121, guaranteed cash value is growing and increasing each and every year. But the 4% isn't a true guaranteed internal rate of return. It is going to vary quite a bit year by year. For most contracts, it probably peaks at about 2.5% if you're looking at a guaranteed actual rate of return, because that is going to be net of the death benefit, or net of the mortality costs. And that also doesn't bring into consideration the guaranteed premiums, because you could have the exact same guaranteed cash value on 2 different contracts, but one of them might have a premium that's 20 or 30% less. So obviously that one's going to have a stronger internal rate of return on the guaranteed cash values, because you're paying a lot less premium to buy the exact same guaranteed performance. So,
Right.
So yeah, there's a lot of different moving pieces there.
Yeah, and that's where I think sometimes, when at CreateTailwind, we show people a lot infinite banking, and there's a lot of people that are out there creating YouTube videos and everything else, and they focus so much on the policy, and they focus on the ratings of the policy. And I always use, Kelly, the example of AIG in 2008 or 9, where 30 days before they were basically insolvent, they had all the top ratings, right? And their derivatives division in London, England, almost brought that company down, like 20 people in one division, because, as you know, derivatives are super risky, and if it goes the wrong way, you're in trouble. So, what I really like about Ameritas, and I've been using Ameritas since I think 2004, is one, they don't overstate dividends, right? They don't over project, which I think some companies out there are using their reserves or using their BD, their broker dealer, to, kind of jack up those dividends. But what are they doing to the company, or what are they doing? Because we've just had one insurance company get in trouble because of their reserving on the annuity side, and they're actually demutualizing. We might touch on that, but talk about that reserving, and really what's important to look at an insurance company from a strength standpoint. Because I think this is where Ameritas really shines, but you have to look a little bit under the surface to see it.
Yeah. I'm glad you brought that up, Jim, because that is an area we really focus on within our business, within our balance sheet. You'll hear our CEO talk a lot about our fortress-like balance sheet and the strength of what we bring to the table. The easiest metric for us to look at is capital and surplus to assets. Everybody publishes that's in Blue Books. And I haven't seen the year-end numbers, but we did just recently update our benchmarking, and it showed our capital and surplus to assets ratio at 11.4%. Industry average is just above 9%. And there's companies that, the opposite extreme from our approach, I'd say, is Athene, where they really try to grow assets as quickly as possible and keep it as little capital behind that as possible, just to be as efficient as possible. Their ratio is less than 2%. So, so there's a big disparity across the industry as to how people are capitalized in their insurance operations. We have, like I said, of the companies we benchmark, the highest capital and surplus to assets ratio. So we feel like we're in a good position to weather some unpleasant times. Over the last year, we've seen that play out in the industry. Where a lot of coronavirus deaths have led to higher than expected mortalities across the industry. When we looked at year-end numbers, it was more than 20% above for the entire life insurance industry in terms of paid death benefits. For us, that isn't really even a blip on our radar screen when you look at the capital position of Ameritas.
Yeah, so that's another great question. I'm glad you brought that up, Kelly, too. Is we had people originally, they were saying, hey, are the insurance companies in trouble because we're going to have all these additional deaths? Now, it's kind of debatable whether, were there 20% more people that actually died in the US? Or was it just the mortality experience that we saw? 20%, like you said, is a blip. It's not going to affect the financial performance of the company or the strength of the company or the capital ratio, reserve ratio. I mean, talk about that a little bit.
Yeah. So when we do a lot of mortality sensitivities as we price our products and try to understand what earnings emergence could look like. What if we're wrong? What if underwriters get a little too aggressive in underwriting risks like Jim Oliver?
Yeah.
And
Don't
any of
tell,
that kind
no,
of stuff.
they cannot be too aggressive with our firm. They can just let them write approve everything.
There you go. But usually we'll look at a pandemic where it'd be a one-time shock in mortality. Those scenarios, we can withstand a pretty severe one-time shock in mortality, 10 times the magnitude we just saw over the past year. So in those terms, the company's well capitalized. The scenario of if we are off and mortality is 20% higher, not just this year, but every year into the future, those are more catastrophic scenarios for Ameritas or for the industry. And that's also one of the advantages of our approach, where we are a multi-line company and we have diversified earnings sources. So we don't put all of our eggs solely in the basket of mortality risk. We've got asset risk, we've got retirement plans business, group dental business. So that helps us in those scenarios as well.
Yeah. I don't think people realize and I don't think the ratings companies give enough credit to that dental business, because that's only helping support the strength of your life insurance contract and your life insurance operations. I mean, that's huge. A lot of companies, they have riskier things in place of that dental, like AIG had a derivatives division.
Right. Yeah. And we've been successful in that dental business for a long time now. We've grown that really quickly over the last 20, 30 years, done some acquisitions within that space too. So it is a meaningful part of our overall enterprise, our revenue, our earnings. So like I said, it is a big help for us to have those diversified earnings bases.
Yeah. So, okay. So Kelly, when we look at what is the industry doing, we talk about low interest rate environment. I mean, we've been in a low interest rate environment now. I mean, this is as long as I can remember in my 55 years on Earth being in this kind of low rate environment. What does the insurance company look at, and what are they doing for a low interest rate environment? And how does that affect the insurance contracts? And then if it turns around and it went the other direction, and we have back like the 80s where we had high interest rates, and Nelson Nash does a great job talking about him getting kind of caught in a high interest rate environment, but his life insurance contracts bailed him out of that. And so talk about those two extremes, or kind of what's happening right now.
Yeah. So in the low interest rate environment, I agree. It's been unprecedented. We thought we were in a low interest rate environment, and then 2020 happened, and whole new level. So it's not really fun to set those kind of records with the 10-year Treasury. But things have really improved here in the last few months. So that's been a nice help. But when you look at the investment grade assets that our asset team is looking to buy to back our portfolios, there is a gap between new money rates, the assets we can buy today, versus where portfolio yields are at. And our products, as well as what we think is everybody else out there in terms of the way they manage their whole life books of business, they look at a portfolio rate approach. So what that means is, as long as new money rates continue to be below where portfolio yields are, there's going to be a slow bleed, a slow trickle of dividend declines. And you've seen that over the last few years, 10 basis points here, 25 basis points there, dividend interest rates migrating downward. So we were probably in 2018, we were really close to seeing new money rates cross over and be stronger than portfolio yields. So there's a lot of excitement, both within Ameritas and across the industry, that, yeah, we might be out of this low interest rate cycle, but things really shifted the other direction too. So, I think if we stay in this environment, there'll continue to be dividend rate declines, and it's just a challenging part of the economic cycle to be in, one we've never been in, where we've seen this low of Treasury environment. But in spite of that, we've been able to maintain pretty competitive dividend interest rate, and we've put more value into our guaranteed cash values. strengthened our paid up riders. So those are some of the ways we've looked to maintain competitiveness and help to keep a really strong product out there, even though the yield hasn't been there to make it quite as exciting as it was 10, 15 years ago.
Yeah, you know what's really interesting about the Ameritas product, and as you know, we look at a lot of different insurance companies, and the guarantees inside the Ameritas contract are just such an attractive part of it, just as a customer buying life insurance and expanding my infinite banking portfolio. But when I look at like a 10-year projection, right? Mm-hmm. And I don't know, I haven't run one. I'm insurance age 56 now, but I guess I could backdate it. But if I'm 45 years old, I know that even as a male select, I'm going to have more money on the guaranteed side than I put in. So in 10 years, I'm going to have guaranteed to have more money than what I put in there. Now think about that. What other thing could you put in money for 10 years and guaranteed worst case scenario, you have more than you put in, and it's got tax advantages. Now, to me, this is where it's so cool. With that lower dividend rate, you know, infinite banking still works, and the insurance company is charging me interest, and I'm using their money, and I'm going out and buying cash flow assets. That's what I do. And it's a win-win because the insurance company is getting a nice return on their money, but I'm using their money to go make more money, which is what a bank does. That's why it's called infinite banking, right? Or it's one of the reasons it's called infinite banking. And so, but I have access to that money. It's a win for the insurance company. I have priority to get that loan over all other investment opportunities for the insurance company. And after 10 years, again, if I'm 45 or 50, about more than 95% of the current market conditions, which is what we're showing on the right side of the ledger with a whole life, right? It's not a projection like a universal life policy. It's not maybe this will happen. We hope that it would return this. This is what it's doing right now in the lowest interest rate environment we've ever seen. So it's 95% guaranteed. That, to me, that's the story. That, you know, that's the story. That's the thing we should be celebrating in the insurance side, because nobody else can say that.
Right. Yeah. You have that floor, that peace of mind on if things really go south across the economy, across the industry, what is that worst case scenario? In our guaranteed side of the ledger, it looks pretty compelling. And you know, as I was just saying, the hope is we're going to see interest rates start to rebound. We'll see the economy start to open back up, GDP start moving in the right direction. So a lot of things that could be trending in the right direction. We see some increases in interest rates and hopefully get out of this lengthy cycle of low interest rates. And in that scenario, what's going to happen? Portfolio yields go up, interest rates go up, dividend interest rates go up. So you're then going to see, if that scenario does play out, you're going to see performance better than what was originally illustrated. So I think it gives you that certainty around this. This is how this is going to perform in an absolute worst case scenario. And now I've got options. You know, maybe the market does improve. Maybe we stay where we're at, but I continue to get dividends and accumulate some growth there. But it does provide that great peace of mind with really strong guaranteed performance.
You know, so I never, like, you know, obviously we even if somebody's 35 years old, you don't say to them, hey, this is the current dividend and dividends are definitely going to go up. You never say that, but we would think that in a normal economic cycle, we can't stay at these low dividends forever, that there's going to be a normalization and maybe even periods of hyperinflation throughout that 35-year-old's lifetime. And but you know, we know the left side of the ledger, the guaranteed side of the ledger, that's worst case scenario, right? And it still looks great, worst case scenario. But we know that the other side, that's the floor. So I mean, the left side's the floor. So you know, what I always tell people is when I'm looking at a universal life, it's a projection. Hey, here's what would happen if interest rates were 7% forever. Well, or whatever number you use. But that's not realistic either, because it would never be that flat growth line of 7% every single year. I think that's the part of universal life that people might look at and think, hey, this is attractive. But Kelly, maybe speak to this. As I always say, again, when I'm talking to people, I'm trying to make things as simple as possible to understand. But with a whole life, the risk is on the insurance company, because they're calculating this for your whole life. They're calculating it actuarially. On a universal life, you're buying a term policy with increasing mortality costs, and you're a side fund of some sort, right? Could be a sub account in a VUL, could be an index, whatever it is. And so the risk is more on you, the policyholder, and with whole life, it's more on the insurance company. Would you agree with that, or is there anything to add to that?
No, I think you hit the nail on the head, and that's really the key distinction between whole life and universal life contracts. When a UL was first launched, whole life was already the predominant product in the marketplace. And let's say you designed a product or designed a policy at $20,000 a year premium on a $1 million policy for a client. You could have sold them a UL contract at the exact same time, and they could pay $100,000 once. They could pay $5,000 for the next 10 years, and then start paying 50 grand. So the big selling point behind UL was flexibility. I can pay my premiums however, whenever I want. I just need to make sure there's enough cash value in there to keep the thing going. So that flexibility was the huge selling point. And then you fast forward 20 years, and that flexibility has agents cursing, why did we give them so much flexibility, when you say, yeah, you can fund a little bit here, you can skip a year here and there, and now I've got this policy that's upside down. So there's a lot of people that have come into the industry, and the way they get in the industry is working on orphan clients. And there were UL contracts written 20 or 25 years ago, and they haven't performed. Interest rates have taken a downward trajectory. And now they're trying to figure out, how do I fix these policies? Well, it's a lot easier to fix it if I know I pay my 10 grand or 20 grand a year into this permanent whole life policy. There isn't going to be a surprise. I know that's the premium forever. There's no flexibility, and that's a good thing, because I know exactly what I'm buying and what I'm going to get out of it. So that is a big distinction between the two contracts, and what's seen maybe as a huge advantage. In some cases, if somebody's got the self-discipline to fund it exactly as they originally planned, yeah, that could help for UL. But in a lot of cases, people don't follow through on that original great plan and great intention.
Yeah, and I think that, I don't want to say this as a blanket statement, but there's a lot of people out there selling it the wrong way. And as you know, I inherited a lot of policies to straighten out. And I would tell you that I've never seen a universal life policy where the client's over 65, where their cash value and everything and their death benefit is anywhere close to the original illustration, because it was set up in a different environment, right? And even in the VUL, I've just never seen one that's outperformed or even performed up to the illustration once the person gets over 65. And I know I'm not telling you anything, but once you get over 65 and that mortality curve starts to look more like the blade of a hockey stick, then you're in trouble. And people would say to me, when I inherited these policies that were set up incorrectly, they would say to me, well, at least I have my death benefit. And I always hated to say to them, no, you're going to have to put more money in there, or you're not going to have the death benefit, right? Yep. On a whole life policy, we never have to apologize for that. And when Ameritas has one of the most competitive paid up additions riders, and the way that I describe that is it's a single pay little insurance contract attached to the base whole life policy, and up to 150% of the base, there's no load in there, right? With Ameritas, talk a little bit about that rider and how that helps flexibility, because it's kind of the flexibility. When people are in the audience, they think, well, gosh, I like that flexibility, but you can have some flexibility. This is, in my opinion, it's the perfect hybrid of getting the whole life guarantees and the whole life kind of a tank that's hard to destroy, and having the flexibility.
Yeah, exactly. So I'll keep my example going on the $20,000 whole life contract. So instead of a $20,000 base premium, we'd set it up as $8,000 of base premium and $12,000 into our paid up rider. There's a couple advantages. The reason I pulled those numbers out of the air, that means our flex paid up rider is going to be designed as optimally as possible, where for the first 150% of your base premium, our paid up rider is not going to charge a premium load. So that $12,000 goes in without a load, and you have guaranteed $12,000 of cash value. So there is an excess load if you go beyond that limit, but that is the most optimal design. And the other advantages of that flex paid up rider is you have the ability to skip premiums on it. You don't need to pay that every year. So if you pay 20 grand into the contract for the first 3 years, the next year you could say, I just want to pay the base premium. I'll pay 8,000, skip this paid up rider premium. And if I wanted to pay more, a lot of situations, somebody gets a raise, they get a bonus, have a windfall. You can put more into that paid up rider. So you can go all the way up to 200%. And you have that flexibility to say, I can pay anywhere from 0 to 24,000 into this paid up rider each and every year. So there is a lot more flexibility in that aspect as well. We designed that, we had a paid up rider that was fully scheduled, fully required you to pay the exact same amount, or you reduce it each and every year. Had a lot of success with that rider, but the biggest drawback was that word flexibility. Is it didn't provide that level of flexibility. So when we launched our first flex paid up rider, had a lot of success with that. Access Whole Life, which we launched a little over a year and a half ago now, that one we further enhanced that flex paid up rider. So there's more room to put in excess amounts of that relative to the base premium, and then a wider range of what you could fund, below and above that planned or scheduled amount. So that was where we were looking for. Yeah, let's get some of those advantages of premium flexibility, but still don't stray from the guaranteed structure and the strength of a whole life chassis.
So let's talk a little bit about the access policy, because I'll tell you, in 2019, everybody had to change their policies to the new mortality table, the 2017 mortality, CSO. Right? So I would just tell you that so many companies missed the mark. I mean, I look at all these companies, right? Because, and so many companies missed the mark. And the company that I saw just hit a home run was Ameritas on this policy. And, if you take a 40 or let's say under 50-year-old female, okay, and you're doing what you said. So I'm going to use, because, you're better at math than me. So I need to use $100,000 premium so that I can figure out the ratios, right? Okay. So at $100,000 premium, 40% base, 60% PUA. If I put 100 grand in the first year, I'm going to have around 62% cash value that first year. Now, here's the cool thing. On a female, if under 50, in that second year, I'm going to have over 100% growth of what I put in. Meaning I put in 100 grand and it's going to be about 102, 103,000 of growth on that. Okay. So other insurance companies are taking 4 or 5 years to get to that. How did Ameritas, how did that happen? How is the design of this policy to where that's possible? I don't know why it's called access, but to me, it's access to your cash. So, I don't know if that's what came into it, but that's how I explain it.
That's exactly the type of language I was looking for with that. Cause it really was about having that liquidity, knowing that you can get to your cash early in the contract. So we thought about names like high early cash value, and there's some in the market that accomplish that, but it's not just about high early cash value. It's strong throughout the whole life of the contract. So, I felt like access, it provides you access, not just year 1, year 2, but year 45, year 60 in the contract. So it really does capture that well. We changed the structure up quite a bit on this. So we made it a shorter paid up guarantee age. And primary reason for doing that was to enhance some of those early guaranteed cash values. So you do see that performance, like you said, right out of the gate. You're looking at year 2, the total premiums you put in year 2 you get all that back through the growth and the cash value just in that second year. So yeah, that is very much intentional in the design of that. And by making it paid up in a shorter period of time, we were able to drive up some of those early guaranteed cash values.
Awesome. And, didn't Kelly, correct me if I'm wrong, but I don't think people in the audience or most insurance agents realize how long it takes for a policy written to be profitable to the insurance company. And one of the advantages that an insurance company has over an individual is they can have a lot longer time horizon, right? And therefore smooth out some of these things like we're talking about today, pandemics and low interest rates, environments, et cetera. But didn't you guys extend the amount of time before the policy was profitable to create some of these performance enhancements too?
Yeah, I'd say relative to most of our currently sold products, this has a longer payback period. So the point where, from the carrier's perspective, when the total distributable earnings of this product exceeds the capital contributed to make that product work, it is a longer period of time than most of our other products. And we were aware of that going in, and we knew what we were signing up for with that. But like I said, we felt like this is a really important part of our product portfolio. Really important that we be as competitive as possible in this space.
Yeah. So, okay, one last thing that I want to touch on, and I appreciate. I'm looking at the timer here, and I'm going longer than most of our episodes, Kelly. But I could probably do a 2-hour episode just because it's so interesting to me. And I've been doing this 33 years, and the more that every day is like a learning experience. Every day is just so. Having access to you is great, and I appreciate you coming on again. Let's talk about these new regulations, the new 7702. Is that the right way to say it? The new 7702 rules, and the changes there, and what are the positives and any negatives that you see going forward in this new environment?
Yeah, so the 7702 changes, it's really about differences in interest rates. So what's happened over the past, 30 plus years, we've only updated mortality tables as those have happened. We were just talking about 2017 CSO that happened at the end of 2019. This surprise kind of happened at the end of last year, where Congress ended up approving changes to these 7702 interest rates. So the way that impacts whole life contracts is the interest rate used in MET calculations in most situations is going to go down in the future. And I say in the future because most contracts on the market today have a contract rate of 4%, just like we were talking about before. That's used in the guaranteed cash value determinations, all those present value calculations we end up doing. That's 4%. That also gets used in the non-forfeiture demonstrations. And up until this past year, there was a 4% floor in that non-forfeiture calculation. So what's going to happen at the end of this year, January 1st of next year, the highest contract rate that's going to be available on the market is 3.75%. And the lowest that anybody could offer is going to be 2%. Now that's good news and bad news. The good news is that provides way more flexibility in the design than we've ever had before in whole life. The bad news is we don't really know what everybody's going to do in terms of their product designs. So I'll provide an example here just to highlight. So the 4% contract rate right now, that is going to get used in the MET calculation to say, all right, we have no impacts on 7-pay premiums. And for those listening that aren't as familiar with this is basically the delineation between where I keep my tax advantages and the cash value of my whole life contract versus having some less advantageous tax treatment. And that is basically just a line in the sand where as soon as I go above this premium amount, it moves into a modified endowment contract status, and then I get taxed in a different way, not quite as attractive as if I'm non-MEC. So if we drop it all the way down to a 2% contract rate for a 40-year-old client, that could mean double the MEC premium. My MEC premium is 20 grand today. New contract with a 2% contract rate, my MEC premium is 40 grand. So the flexibility in design is going to be way greater moving forward. But that also means that there's going to be a huge shift between what people are used to seeing for products today versus what they're going to see in the future, and is it going to check all the boxes, accomplish everything we want. The other thing that's really non-intuitive is as you lower that contract rate, you push those guaranteed cash values higher. And if we go back to that example where I was talking about age 121, $1 million of cash value for $1 million of death benefit, you're present valuing that amount back at a lower rate each and every year. So if you look at a 50-year-old, instead of using 4% to present value that $1 million back, I'm using 2%. That means I'm going to have higher guaranteed cash values all throughout the contract by using that lower interest rate. So the non-intuitive answer is we lower a contract rate from 4% all the way down to 2.5% or 2%, and my guaranteed cash values go way up. That's a good thing. From the carrier's perspective, we're not going to be able to afford paying substantially higher guaranteed cash values at the same premium. So if somebody goes to an interest rate that low, all odds are they're going to move up the guaranteed premiums to help offset some of those costs. So as a long-winded answer to your question, it really means there's going to be huge shifts in the way companies design their contracts. Everybody in the marketplace is going to have to refile and rebuild their whole life policies between now and the end of the year, so that come January 1st, everybody's compliant with this new regulation. So there's a lot of work already happening within Ameritas. I know a lot of work happening across the industry to get ready for these updates. But that's just a little thumbnail sketch as to what we're up to with that.
That's awesome. And the thing is that what I've seen from the last time we retooled all of these policies is, I think Ameritas kind of stood out in their in really making sure that it was a competitive product. And I have no doubt that you guys will do that again in this retooling. And we would expect like this access policy that we're talking about to be available at least through the end of the year.
Oh yeah, yep, absolutely. So the end date, in our current form, all of our whole life products will be available till the end of the year, and then we'll be working through updates to be in market first of the year with the new rates. So like I said, the biggest change, everybody's got to move that contract rate. So if you look, there's the range, what could be offered right now is between 4% and 4.5%. People are going to be filing those, and come January of next year, they're all going to have to come down at least a little bit and potentially a lot, anywhere in that 2 to 3.75% range.
Right. Yeah, it's funny you talk about the cost and the premium, in a policy. And there's one company out there that touts their dividend all the time, and I don't know why they do, because their dividend is not higher really than anybody else's, but their expense, their actual base premium for $1 million policy is considerably higher. And what they do is they put a term rider on there that kind of the dividend buys out the term rider. And I know, and I don't want to name names of the company, but if I take an Ameritas policy and I put the additional PUA in there, and because our the Ameritas premium is a lot lower, so that I put that additional PUA in there, just like blows away their policy. But I think you know what I'm talking about. But I think that that eliminating with this new rule, I think we're going to eliminate a lot of term riders. And I've never been a big fan of putting term riders on, especially on an infinite banking policy, because I've seen companies, Kelly, where the dividend has gone down and it's created a mech because of this term rider. And this should eliminate those issues, shouldn't it? The new rules?
Yeah, it'll certainly help with that issue. And we plan to continue to have term riders available because there's definitely designs where it could make sense. And, depending on what the need is, if it really is just about, I have a short-term protection need and it's not being used to help get to a stronger mech performance, it's more efficient. I save a policy fee. It's the same competitive premiums you can get on a value plus term or standalone term product. But I save a policy fee. Yeah, why not put it on the whole life contract? But I definitely agree with you that there are a lot of scenarios where funded absolutely optimally, as efficiently as possible, using a term rider to make that happen. The dividend doesn't always play out exactly the way it was originally illustrated, and you could have an inadvertent MEC at some point in the future. And we'll usually work with people to, maybe we need to reduce the term piece and come up with a way to avoid that MEC and get that fixed retroactively. But so we're very accommodating on that side of things, but it does end up creating some more challenges for you as the producer, trying to make sure that thing works as efficiently and cleanly as possible.
I'm thinking of like the person that says, hey, there are people out there that they're really touting the PUA, and the way that they get more PUA and less base premium is by using the term rider. And I think that's kind of manipulating it too much. And what I mean by that is somebody would say, I want 10% base. Let's use my $100,000 premium. I want 10% base and I want a $90,000 PUA. Well, where the leveraging of the policy really happens is in the base side. But like you said, I'm going to have load in my PUA now. I'm going to have this term cost. I'm going to have this exposure. And really all I'm gaining is a little bit higher cash value that first year. I'm not gaining anything long-term, and that term rider then becomes dangerous because I don't have very much base if something happens in dividends and et cetera. It just, to me, and then they tell people, which isn't, you maybe speak to this, is, well, we'll just take the term rider off there after 7 years, but they've projected the PUA for 10 years. Like that doesn't work, does it?
It does not work. Yeah. Every dollar of paid up rider we receive is treated as a material change. So there's going to be a new calculation of the MEC premium. And then if we receive another dollar premium after that, it's constantly recalculating your capacity to put additional dollars of premium in. So it is creating potential future issues if you're going to drop that term rider off at some point in the future before you fully intend to stop funding. If you're going to do a 10 pay, I put a 10-year term rider on it. I RPU at the end of those 10 years. I'm probably in good shape there. But if I want to keep paying the paid up rider for another 5 or 10 years after that, that's where you run into problems where I don't have the room, death benefit wise, to keep throwing that much money into it.
Yeah. So, what I always say is I don't want to plan somebody's insurance future where failure is an option. That's why we don't use universal life. And that's why we don't use these big. I mean, we occasionally use a small term rider just to keep it under the MEC line. And depending on your age and your underwriting class and everything else, but the big rider where it's like 90-10 and this big rider, we just don't do it because I think you bring failure into it to where, like you said, hey, I'm going to have to RPU it. And if I'm buying cash flowing assets with my cash value or by collateralizing my cash value and using the insurance companies to go buy these assets, I'm going to have a lot of money flowing back into the insurance contract. And so I got to be able to hold that. And, Nelson always talked about volume over rate. Well, Kelly, I think I could talk about this stuff all day, and I've kept you longer than almost longer than I promised. So the one thing I ask everybody, and this doesn't have to be related to insurance or anything else, but Kelly, what's one book that you've read in your life that you'd recommend, everybody read? Is there a book that comes to mind when I ask you that question?
A book that everybody has to read. Well, from a business standpoint, I love Good to Great. I really enjoyed that book. So I've referenced that a number of times over my career. I have a house full of young kids, and my favorite book to read to them has been Little House on the Prairie series. Yeah. So that's a good go-to just for those of you that are trying to keep the kids engaged and remember a little bit more challenging time. We think we got it hard right now, but is a little more difficult back in the day. So those are two that far opposite ends of the spectrum, but those are ones that definitely have an influence on me and my family.
Here's something else, Kelly, that I'd recommend for all littler kids is the Tuttle Twin books, which are free economics. It takes like Austrian economics, free market, and it makes it really interesting. And they have a whole little series of books. I think you can buy the whole series as a package. But if you go to like TuttleTwins.com or something like that, or just search Tuttle Twins, But those are great books, and I'm sure your kids would love them. If you get them, let me know what you think. Okay, well, let's wrap this up. This has been really interesting. We try to on this show bring the audience people that are out there using policies and infinite banking, people that are doing real estate investing, people that are syndicators, people, all kinds of things. And it's rare that we get somebody to be really transparent and authentic from the insurance company and being so open. So I thank you so much, Kelly, for coming on. Definitely is going to be an episode that I'm going to look forward to listening to again.
Excellent, Jim. Thanks so much for having me. It's always a great time getting to connect with you, and appreciate you giving me a chance to talk not just to you, but to your whole audience. So very much appreciated. Absolutely.
Okay. Until next time, audience, you got to break away. And one of the ways that you break away is you educate yourself. And today you got an education on how an insurance contract works, how actuaries think, and how insurance companies posture themselves for the future and protect you as a policyholder. And until next time, break away from the herd, because nothing good happens in the herd.